Hey everybody, today we're going to build the cost of equity and the WACC for Costco. So let's get straight into it and I'll commentate as we're going. First of all, we're going to build out this cost of equity looking at the three components of the risk-free rate. We're going to build a bottom-up beta and then we're going to calculate an equity risk premium. This one for Costco is going to be a bit different to what we've done in the past because we actually have, or we can work out the breakdown for the other countries where Costco has its stores. And from that, we can derive where their revenues are coming from and come up with a cost of equity. And after that, we're then going to plug it into the WACC and we'll see what the risk rate is or the discount rate is for the company. So let's get straight into it. First of all, let's start with the cost of equity. So open up a new sheet. As always, the first thing we do is let's insert another, first of all, we go view, we freeze the first column, and then let's insert another column here. Let's make A smaller and B larger. There we go. We want to take off the grid lines, and we're going to do the cost of equity first. So let's just put an X there so we know it's the start of a section. And we take it to about there. Fill it with a blue font. Let's go white, obviously. So cost of equity, and this, as we know, consists of the risk-free rate, the beta, and the equity risk premium. And then, actually, let's do it to the cost. Cost of equity at the top. And yeah, let's do a bit of formatting. And as we know, so the cost of equity is equal to the risk-free rate plus the beta multiplied by the equity risk premium. So that's how we calculate it. And we can get this to auto-populate. So we'll go cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. And obviously 0 at the moment because we haven't done anything. So let's go on to the next section, which is the risk-free rate. This is always the easiest. And the risk-free rate will be the US 10-year government bond. We build that, and that is going to be, right now, that is, let's have a look, 4.159%. And yeah, I mean, let's put a border there. And that's it, that's the risk-free rate, that's done. The next one is the bottom-up beta. And this is, I mean, for these components, it's as if they get progressively harder. You've got your risk-free rate first, which is we just look at what the figure is. And then we have to do the beta and then the equity risk premium. And depending on how global the revenues are for the company, the more, I guess, components into it that goes. But let's start with the beta first. And that is going to be, so for the beta, we need the industry, then we need the sample size. I mean, the sample size is not really that important. Then the unlevered beta for that industry, then it's revenues, then we need the EV, the enterprise value to sales. Then after that, we need the weight. Sorry, no, it's not the weight next. It's the value. So that's the EV to sales ratio multiplied by the revenue. So the value of that segment for the company, then proportion, and then weighted beta. Well, we'll call it weight so it fits. And then we have then we work out what the levered beta is going to be. So the first industry for Costco, I think, will be retail. We're going to take it from, again, from Professor Damodaran at NYU. We'll look at his data. So he does the betas by sector, and this is for the US. So we go down to Costco, and we can see there's retail, and there's retail, grocery, and food. So yeah, we'll put those in. So we go retail general and retail grocery and food. And the sample size for both of those, for retail general, is 24 and 17 for grocery and food. The unlevered beta is, so that is, sorry, yeah, you can still see the unlevered. Let's get it down to, where is it gone? It's this bit here. So 0.99 and 0.42. And the revenues for this, I've already built this out. So we're just going to take the revenues that we already, that I've already done in the analysis, and then that way it can, when we build out the DCF, we'll go back to it. It's not the ideal way, but I wanted to break this into two segments. So we'll just type the numbers in for what they're going to be. So let's 1, 2, okay. It's going to equal non-food plus warehouse, and we'll put the memberships in there too. And the retail and grocery is food plus fresh food. So if you, in your, just type these numbers in. So for retail general, put the revenues as 127,642,000. Write it as 127,642 though, because obviously this is in millions. Then the retail grocery 147,640. Yeah, if you just write that in, then on the next one we'll make it more dynamic. But for now, this is fine. The next thing we want to do is go to the EV to sales and work out what the value of each of these segments for the company are. And to do that, again, we go to this spreadsheet here. These are all on Professor Damodaran's website. You can download his data for free, and he updates them. So for example, the price to sales data, the EV to sales data, he updates annually. Okay, so retail general 2.05 and retail grocery and food is 0.49. Sorry, I'll highlight these two and I'll zoom in as well. There we go. 2.05, 0.49. And then that means the value for these segments. So you do revenues multiplied by the EV to sales. and that gives that segment a value of 261 billion. And we do the same, we can just copy, control, paste. Let's just work out the sum. Now proportion is going to be, we do the value divided by the total value, and remember to lock this one in, and that gives us 78%, well, 0.78, there we go, and we can bring that down, just make sure, always make sure it equals to 1, perfect. And then now for the weighted beta, we go unlevered beta multiplied by the proportion. And that gives us, I mean, the unlevered beta is nearly 1 anyway, so it's not going to be too far off what the proportion is. And we do the same for this one, for retail, grocery, and food. And there we have it. The beta is, then we sum, is 0.87. Now, we know, so we have the unlevered beta, and what we need to do is calculate what the levered beta is. And the formula for that, let's just come up a bit, is unlevered beta equals the levered beta divided by 1 plus 1 minus the tax rate multiplied by the debt divided by the equity. So if we rearrange that, we get levered beta equals unlevered beta multiplied by 1 plus 1 minus the tax rate multiplied by the debt divided by the equity. And obviously we don't at the moment, because we haven't done the other side of the on the WACC yet. Actually, so we'll just put them in and then we'll make it dynamic afterwards. So okay, so we know the unlevered beta is actually no, yeah, we're going to go through the financial statements and we're going to find out what the debt is. The equity, we know it's the market cap of the company, so we're going to find out how much debt they have and divide it by the market cap, and we'll also find the tax rate in the SEC filing. So this is the most recent. Yeah, this is the most recent one. And we need to go. Okay, let's get these. Let's just get these. So let's find the tax rate. It is. I know what it is. Here it is. But I just wanted to show you so that we so that you know where to find these. We're going to use this one, the 24.9%, the effective tax rate for the 36 weeks ended at this point. Because Costco's financial statements, they go, I think it's September to September, that's their annual year. So it's about to announce its full year results. So once we've got this in the DCF, we're then going to, well, see how they compare. And we'll put in the latest figures when that comes out. But we'll do both because it's a good company to analyze. So yeah, the tax rate is 24.9%. Let's get to the debt. And that is on the balance sheet. Here we are. So we're going to look at, in the liabilities, there's no debt in the current, so we're going to go long-term debt, and we're going to go long-term operating lease liabilities. So we will add those two together. We're going to put these into the WACC afterwards, but I just want to do this in one go rather than switching sheets because that could end up getting a bit confusing. So this is our debt. And then we're going to, the equity is going to equal, what is the best way to do this now? It is actually, you know what, let's go and start filling out the WACC sheet, and we're going to return to this just so that it's clear and we can make sure that it's dynamic. I should have done that at the start, to be honest. Again, go stocks. I'll take the grid lines up in a second. So market cap is going to equal A1 market, and always divide by 1 million to give us like that percentage of equity, cost of equity, risk-free rate, beta, equity, risk premium. Let's make this one a bit bigger. Do the usual. Equity risk premium. Then we take debt, percentage of debt, cost of debt. Then what's the other one? Tax rate, total WACC. So let's just focus on the debt for now. Long-term debt equals 5717 plus 2463, and that gives us the just over 8 billion in debt. I think one thing we're going to see is that, I mean, Costco's market cap is nearly 424 billion, and the debt is 8 billion of it. It's barely anything of the company, so it's not going to have that much impact on the WACC. We'll see that when we just do the percentages here. Cost percentage of debt. You'll see, like, it's no. Yes, it's 2%, and what was it? It was 24.9% for the tax rate. So yeah, for now, that's all we need until we so we can get rid of these. This is all we need whilst we just do the unlevered beta calculation, the levered beta calculation, and then we can go back to the other part of building. So we take the unlevered beta multiplied by 1 plus 1 minus the tax rate, close brackets, multiplied by the debt divided by the, did I do that? Sorry, I've done that completely wrong. Multiplied by the debt divided by the equity. There we go. And yeah, I mean, as you can see, the debt is so small that it barely changes the beta. Okay, we have that now. So let's equals, what is that going to be? J20. Now let's go on to the equity risk premium. And for this, what we're going to look at is the breakdown of Costco's revenues by region. And it does this so it shows the figures for the United States, for Canada, then it groups the rest of the world into one. But what we can do is, and I will show you now, I did this a bit earlier, is I found out how many stores Costco has globally, and that's 910. And we're taking, so we break that down. We have, in the US, they have more than 600. In Canada, they have 110. And then we work out the average revenue by store. So we take this figure and divide it by the numbers of stores for each region. And then we take an average for all the internationals, and then we multiply it by the number of stores. and that gives us the revenue per country, and then we can work out the equity risk premium there. So let's start building this out. So we have 2025 here, then we have sorry, my mind went blank. Weight, then we have ERP and weighted ERP. And let's start with, so US and Canada we'll put in the same section, and then we'll do an other international. So let's just put a bit of formatting in. Sorry, I'm coming down to the bottom of the screen. Let's pull this up a bit. So total, here we go. And then we'll have an other international, and we will break that down, but we'll just put the aggregated into this section. So the US revenues up until now are 36 weeks, 137,819. In Canada, total revenue 25,021. And the weight, so we take the sum. But remember to lock in that, so then we just always make sure that this equals 1. Then the equity risk premium. So we pull up the spreadsheet from Demodron again, and we can look up the country by, or the country's equity risk premium. So let's start with the US. And there it is, 4.62. We'll take Canada's now, so that we don't have to come back to it straight away. 4.21, so 4.62 and 4.21. 4.21%. And so the weighted ERP is going to be, no, and these need to be in percentages. It confused me for a second. Then we just sum those at 4.56. Now, what we'll do is okay, so to save time, I'm going to copy all of the other countries. Oh, sorry, 1 second. We'll come down here. So we've got Mexico, Japan, UK, South Korea, Australia, Taiwan, China, Spain, France, Sweden, Iceland, and New Zealand. And we're going to do exactly the same. We're going to go through the spreadsheet, work out what the country risk premium is, and then, well, obviously work out what ratio each country is relative to that revenue, and then we can add it all together, and then we can get one big risk premium. So, I mean, for speed, I'm just going to copy and paste, but the way that these are calculated are, we go into, so on this page, we take the other international revenue. Actually, let's do this from scratch. Actually, I'll tell you what. Because for these figures here, I've done up to the 3rd quarter, whereas the other one I've done for the year. So it needs to be changed anyway. So other international revenue we know that is 24733, 24,733 up until the on the third financial statement of the year. That's what the revenue was for rest of the world. So what we need to do is we take this figure and we come back onto the store analysis page. And we know that they have 174 international stores. We're going to go equals, we take this revenue and we divide it by 174. So up until now, they're averaging 142 million per store for the rest of the world. Ignore these figures at the moment because these are done for annually. So let's just focus on this, and then we take to work out what the revenue per country is going to be, we take the number of stores and we multiply that by the average revenue. And so let's lock this in and we bring it down, and that gives us our revenue per country. We take this now and we come here. No, that wasn't right. What's happening? Number data. There we go. And then, so we know so to work out the weight, we go equals, and we take the Mexican revenue and divide it by other international. We lock in other international, and let's just do a bit of formatting, and we just bring that down all the way. And so the ERP, again, what we would do is we would go to the other Damodaran spreadsheet, this one, and we would say Mexico. Where is it? There we go. And that's got an equity risk premium of 7.3. So we would do that for each of these countries, but I've already done it. So let's just copy paste. And then we do the weighted ERP is the ERP multiplied by the weight. And obviously these need to be percentages. And we sum. That's going to be 5.53%. So for other international, the weight of this, I think let's do it this way. We do need a total revenue, and that's going to be the ERP is then we go Now we have it. No. 0.73. So there we have it. Is this a line? Yeah. So the ERP for other international is 5.53%. Okay, let's just come out a bit. Yeah, so the ERP for other international is 5.53%, and we've done that by taking a weighted ERP of the weighted equity risk premiums for each country relative to how much revenues they generate and their risk premium. So then, as other international is such a small part of total revenue, well, it's a small part of total revenue, we then weight it to what it is to that, and that is going to give us a total risk premium when you add the 4.56 plus 0.73, and that gives us 5.29%. And that is our total risk premium for the company. So let's F31. So let's plug this in here. And then now we have our cost of equity, we have our risk-free rate, we have our beta, and the risk premium of 5.29%. So let me just zoom back in a bit. So yeah, risk-free rate plus the beta multiplied by the equity risk premium, and that gives us our cost of equity. Now let's come onto the WACC, and this is going to, well, let's ignore these for now, and we'll just plug it in. Some people like it neater that they're all in one place, but it's okay for. And the cost of debt, what we will do is, let's take the interest expense. Again, the debt is so small in the ratios for Costco that it's really not going to be a problem. So as you can see, it's okay, let's just make this a bit bigger. The interest expense for the 36 weeks ended was 108 million. So what we will do there is we'll go 108 divided by 36 multiplied by 52, 156. That gives us what the annual interest expense should be. So if we go equals 156 divided by 8180, that gives us about a 2% cost of debt. Let's maybe give these a bit more, a couple more decimal places. There we go. Looks good. Yeah, so nearly 2%. Now let's calculate the WACC. The WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So let's do that now. Equals percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. And that will give us a WACC of 8.67%. So there we have it. Costco's WACC is 8.67%. Thank you for listening, and we will build out the full DCF either probably tomorrow or the following day. And thank you for listening, and I look forward to seeing you on the next one. Thank you. Bye.